Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at D-Wave Quantum.
If you find our talks useful, please consider subscribe, like, and comment underneath because, for anyone managing their own portfolio, the absolute holy grail is spotting that exact moment when a company stops being a speculative science project and actually starts generating real, undeniable commercial revenue.
Yeah, that inflection point is everything.
It really is.
Right.
And today, we are looking at a situation that just perfectly illustrates that transition. The goal here is to help you understand the extreme risk-reward profile of this stock and really help you decide if these massive price targets are justified for your own long-term wealth building.
Right, because if you want to understand a stock, you really just have to follow the money.
Exactly.
And for D-Wave Quantum, the revenue trajectory just hit a massive, massive inflection point. If you look at the recent financial disclosures last year, they reported an annual revenue of $24.1 million.
Which is, that's respectable for early-stage tech.
Yeah. Sure, it's respectable, but it's still firmly in the territory of a company burning through capital to fund research, right?
Right.
But here is where the thesis completely fractures from the historical data. In January 2026 alone, they secured over $30 million in new bookings.
Wait, $30 million in 1 month?
In a single month.
After doing $24 million for the entire previous year.
Exactly. They generated more in new commercial commitments in 31 days than they did in the entirety of the previous 12 months.
Okay, let's unpack this, because that isn't just a slight beat on earnings. That fundamentally changes the math for anyone trying to value the stock.
It absolutely does.
It really reminds me of a clinical stage biotech company.
Oh, that's a great comparison.
Right. Like for years, they just bleed cash, running trials, publishing papers, surviving purely on investor hope. And then one Tuesday, the FDA approves their flagship drug, a hospital network signs an exclusive purchasing agreement, and the entire financial architecture of the business it transforms overnight.
What's fascinating here is the structure of that $30 million figure. That's what provides the real signal to institutional buyers.
Okay, break that down for us.
It's split between two distinct anchors. The first is a $20 million hardware sale to Florida Atlantic University. They are literally selling a physical Advantage 2 system.
Wow, $20 million just for the hardware.
Yep. And the second anchor is a $10 million agreement for quantum computing as a service, or QBTS, with an unnamed Fortune 100 company.
So they are securing this high-margin, upfront hardware capital while simultaneously locking in recurring software service revenue. That's huge.
It is the exact signal institutional investors look for. It gives them a tangible path to positive cash flow, which totally separates them from peers who are just, purely burning cash on research.
We are definitely going to come back to that unnamed Fortune 100 client because the implications there are just staggering.
Oh, absolutely.
But first, I want to understand the why here. These institutions, whether it's Florida Atlantic University or a global Fortune 100 corporation, they have infinite resources.
Right, they can buy whatever they want.
Exactly. They could partner with any legacy tech giant on the planet. Why choose this specific company for a $20 million system?
Well, the answer really lies in their highly unique competitive moat. It's a dual platform strategy.
Okay, dual platform.
Yeah, so unlike competitors like Google or IonQ, who solely focus on what's called gate model computing, D-Wave Quantum is the only company building both annealing and gate model quantum computers.
Okay, I need to stop you there because the moment we start throwing around terms like quantum annealing and gate model, my eyes just start to glaze over.
Fair enough, it gets dense quickly.
And I'm sure the listener feels the same way. So let's break this down. If you are an investor trying to figure out what exactly you are buying a piece of, how do these two technologies actually work? And why does building both create a competitive advantage?
Let's use a visual. Imagine you are dropped into a sprawling, incredibly rugged mountain range blindfolded, and your only goal is to find the absolute lowest valley in the entire landscape.
Okay, I'm blindfolded in the mountains. Got it.
Right. If you use a classical computer, the kind we use every day, it essentially checks the altitude of every single square inch of the mountain, step by step, one after another.
Because it processes data sequentially. It has to finish checking point A before it can move to point B.
Precisely. And if the mountain range is complex enough, like, say, routing 1,000 delivery trucks or optimizing a global supply chain, it would take the classical computer millions of years to check every possibility.
Which obviously doesn't work for a real-world supply chain.
Exactly. Now enter quantum annealing. Instead of walking the mountain step by step, quantum annealing essentially floods the entire mountain range with water all at once.
Oh, wow.
Yeah, the water naturally and instantly pools in the lowest valleys. The system uses the fundamental laws of quantum physics to just naturally settle into the lowest energy state, which corresponds to the optimal solution.
So it finds the answer globally, almost
All
instantly.
right, that is what annealing does, and it is exceptionally good at solving those logistical and optimization problems right now, today.
Okay, the water metaphor makes total sense for optimization. But if annealing solves these incredibly complex logistical problems today, why is the rest of the industry, and this company too, spending billions developing the other side, the gate model computers?
Well, because annealing is highly specialized. It's a brilliant tool, but it only solves optimization problems. Gate model quantum computing is the holy grail of universal calculation.
So it's more like a traditional computer, but just way faster.
Basically, it functions closer to how our current computers work, using logic gates, but it utilizes qubits to process exponentially more information. A gate model system could simulate new pharmaceutical molecules or break advanced cryptography. It's the universal machine of tomorrow.
Ah, I see. So the strategy here is about bridging the timeline. They offer optimization solutions today via annealing, while building universal systems of tomorrow with the gate model.
Exactly. They effectively de-risk the technology transition for enterprise clients.
Right, so the Fortune 100 client isn't just buying a science project for 2030. They're buying an optimization tool they can actually use next quarter.
Yes, and the recent acquisition of Quantum Circuits plays directly into that. It was a strategic move that expands their tech stack without draining immediate cash.
They integrated new engineering talent and IP to ensure they don't fall behind in the universal computing race.
While still making money off their annealing tech right now. And speaking of making money right now, think about that $20 million deal with Florida Atlantic University.
Yeah, let's talk about the physical reality of this technology, because I think investors often overlook that in an era where everyone is just obsessed with cloud software.
They really do. They aren't just sending a software license to a server at FAU. They are delivering a massive, hyper-cooled, room-sized machine.
Right.
Physically installing a massive system at FAU creates a literal physical barrier to entry for competitors in a major academic hub.
It's the ultimate sticky product. You
Yeah.
don't just casually unplug a multi-million-dollar cryogenically cooled quantum computer
Yeah.
and swap it out for a competitor's model.
Definitely not.
Especially not just because they offered a 10% discount. Once that machine is integrated into the university's research pipeline, you have secured a generational customer.
And those university students eventually graduate. If they spent 4 years training exclusively on this specific architecture, they are going to champion that same architecture when they become chief technology officers at Fortune 500 companies.
That is a massive long-term talent funnel. But wait, let me play devil's advocate for a second. Isn't Google breathing down their neck?
Always.
Right, they just announced a dual-track strategy on March 25th. Are we looking at a David and Goliath situation where David's tech moat might just get paved over by Goliath's endless billions?
The tension between a massive enterprise contracts and looming tech giant competition is real. It's the primary reason the stock chart looks like a seismograph right now.
A brutal tug of war between the bulls and bears.
Exactly. Google has unparalleled capital, but the counterargument is timeline and execution. Google is presenting slide decks about their capabilities in 2030. D-Wave Quantum just signed $30 million in actual contracts in a single month in 2026.
And the enterprise market has a limited attention span.
Right. If a logistics company needs to cut fuel costs by optimizing global shipping routes today, they cannot wait 4 years for Google to perfect their error correction algorithms.
Which perfectly transitions into how the broader market is violently reacting to this exact tension.
Yeah.
If you pull up the stock chart, the momentum is just dizzying. I mean, up 854% in 2024.
Insane.
Followed by another 211% in 2025. It's an absolute parabolic run. But more recently, the stock suffered a brutal 37% year-to-date decline, bringing the price down to around $16.45.
Right.
For anyone studying technical analysis, this current level looks remarkably like a rounding bottom, a stabilization point
Right.
where buyers are finally stepping back in to absorb the selling pressure.
That 37% contraction is the manifestation of the bear case, and we have to examine their core argument. The company currently holds a $6.64 billion market cap.
On only 24.1 million in realized historical revenue.
That is a massive price-to-sales disconnect. When institutional bears, like the analysts at Zacks Research and Weiss Ratings, look at that valuation, the math simply does not compute.
It sets off every alarm bell in an old-school value investor's head.
Right. They issued strong sell ratings because they believe the stock has priced in years of flawless execution that hasn't actually materialized on the audited financial statements yet.
Yeah, but the counter-narrative from the bulls is equally aggressive. Wedbush recently initiated coverage with a $35 price target, and Jefferies went even higher, setting their target at $45.
And firms like Evercore and Benchmark are echoing these outperform ratings. They are looking past the trailing $24 million figure. They view the historical revenue as a rearview mirror metric that is entirely irrelevant following the $30 million January surge.
And the trading volume confirms that institutions are taking these targets seriously. We're seeing over 20 million shares exchange hands in recent sessions. This stock has a highly volatile nature, a really high beta. It can rally 20% in a single afternoon.
Or plummet just as fast on a missed deadline.
True. But here's where it gets really interesting. If you look past the price action, there are operational clues that just scream insider confidence.
Oh, like the headcount growth.
Yes. Employee headcount grew by 50.2% year-over-year to 288 people. And they just relocated their global headquarters to the Boca Raton Innovation Campus.
Which is definitely not a cheap move.
No, it's not. Let's analyze that from a pure business operations standpoint. If you're a CEO relying entirely on speculative research grants and your stock just took a 37% hit, you implement hiring freezes.
You tighten the belt?
You absolutely do not scale your highly paid engineering workforce by 50% and sign a lease for a sprawling new headquarters in a premium innovation park unless you possess a concrete, fully locked-in pipeline of commercial contracts that urgently require fulfillment.
That operational expansion validates the $30 million bookings metric. It's the difference between preparing for a winter storm and building a larger warehouse to handle a surge in orders.
Exactly. So for you, the listener, if you're considering allocating capital here, understanding the technology and the history is only half the battle. You have to know what specific events could act as the catalyst to push the stock from its current $16 range toward those $35 or $45 targets.
We need to map out the critical milestones.
What's on the catalyst calendar? What do we need to watch over the next 3 months?
Well, first is revenue recognition from that $20 million FAU deal. The market is waiting to see the exact quarter when that hardware deal officially clears the accounting standards and lands on the income statement.
Because the moment that trailing revenue figure jumps from 24 million to 44 million or higher, that astronomical price to sales multiple compresses.
Right, forcing the bearish analysts to recalculate their models. Second, we need updates on the gate model side of the business. We're expecting key updates regarding the integration of the Quantum Circuits acquisition in the first quarter of 2026.
The market needs technical proof that this bolt-on acquisition actually accelerated their timeline rather than just acting as an expensive distraction.
Exactly. The third factor is macroeconomic. We must monitor the Federal Reserve and the trajectory of interest rates later this year.
Let me jump in there. I understand why highly leveraged real estate firms obsess over a quarter-point rate cut, but how deeply does the macroeconomic environment really impact a company building advanced computing hardware?
It impacts them profoundly. Manufacturing and deploying room-sized, cryogenically cooled hardware is incredibly capital-intensive. When interest rates are elevated, the cost of financing that manufacturing soars.
Makes sense.
More importantly, institutional investors use discount rates to value a company's future earnings. When the Federal Reserve cuts rates, the mathematical value of this company's future cash flows instantly increases in those institutional models.
Ah, so a dovish Fed is a structural tailwind for any growth stage hardware developer.
Precisely. Cheaper capital accelerates physical expansion.
Okay, so that's 3. What is the fourth catalyst?
The fourth, and arguably the most compelling, is the rumor mill surrounding that mystery Fortune 100 client.
Right, the $10 million services agreement.
The identity of this partner remains heavily guarded. Unmasking that client could serve as a watershed moment for the entire sector. If the partner had revealed to be a Tier 1 logistics giant utilizing the annealing technology for supply routing, it proves the commercial viability.
However, the speculation is leaning heavily toward the defense sector.
It is.
And if a major aerospace or defense contractor is utilizing this computing power, it changes the entire narrative. We're no longer just talking about corporate optimization. We are talking about national security, cryptography, and defense logistics.
The moment a defense prime is officially attached to this technology, the institutional capital that flows into aerospace and defense will be forced to take notice.
If we connect this to the bigger picture, it sounds like the market might just be mispricing the speed of commercialization here.
I think so. Synthesizing the technological moat, the recent commercial validation, and the impending catalysts, the investment thesis crystallizes into an 8 out of 10 bullish score.
An 8 out of 10.
Yes. The potential upside justifies the inherent volatility. However, anyone allocating capital here must treat this strictly as a long-term hold, looking out 12 months or beyond.
You cannot day trade a technological revolution.
You really can't.
So what does this all mean for you? Building wealth in emerging sectors requires looking past short-term volatility. You must possess the psychological discipline to ignore the daily noise.
Because the 37% pullbacks will happen.
They will, and the bearish reports focused on lagging indicators will persist. But the underlying reality is that institutions are now writing 8-figure checks for this hardware today. The transition from theoretical research to enterprise commercialization is actively unfolding.
As you evaluate how this fits into your overall wealth strategy, consider the long-term implications of that physical infrastructure.
It's a massive shift.
It is. Consider this. If the rumor mill is accurate and defense contractors begin integrating this hardware, the technology transcends commercial utility. If quantum capability becomes a prerequisite for national security, does possessing physical, proprietary computing hardware embedded within university research labs and secure enterprise facilities become the ultimate impenetrable competitive moat in an economy that has forgotten how to build physical things?